Well, good afternoon, everyone, and thanks for the invitation. And I see once again you saved the best for last, so I'm very flattered. Thank you for that. Now, some of you are probably sick and tired of seeing me and hearing me talk about deductions, and if that's the case, that's probably a good thing because it means that you know this material backwards and forwards and it's second nature to you. If you're not sick and tired of me yet, I'll do my best to change that. Now, we're running a bit early today, which is helpful because I thought I might spill over my hour allotment, so this might work out all right. I'll do my best to get through the material as efficiently as I can. But rest assured, I did bring some fresh lawyer jokes with me, and so we should have time to throw those in. So, and I think you'll enjoy these. I really do. The assessors, at least, liked a couple of them. So, but anyhow, we'll start as we always do with just a bit of a primer on the difference between a deduction, exemption, and credit. And a deduction basically reduces the amount of assessed value that's subject to taxation. An exemption excludes a property from taxation and in some cases even assessment. And a credit reduces the tax liability that's been calculated. And sometimes people use these terms interchangeably. They'll say a homestead exemption. There is no such thing. It's important to get the terminology right because these things do mean different things. They work differently. They function differently. So the terminology does make a difference. And as I always say, this is my lawyerly disclaimer, this presentation, other presentations from the DLGF and memos and so forth are not substitutes for the law. They are not the law themselves. They're just meant to be helpful or informative. In all cases, the Indiana Code always governs. And if you're not sure about something, feel free to contact us and ask us. We'll do our best to answer your question. If we don't know the answer, we'll refer you to someone who might be able to help. Obviously, our agency doesn't oversee every single thing that pertains to local government or local financing. So there are limits to what we know or what we specialize in, but we'll try to help point you in the right direction. And don't forget your county attorney may also be a helpful resource in some cases. Now, this slide here just demonstrates how a deduction would work. The homestead deduction always goes on first, and then the supplemental homestead deduction. State statute doesn't really dictate the order in which the other deductions are applied. However, I think from a policy perspective, putting the disabled vet deduction on last makes the most sense because a disabled vet who has an unused portion of a disabled vet deduction remaining can use that balance toward excise taxes. So it might make sense to apply that one last, but there really is no statutory order to apply the other deductions. Now, a lot of what's in this presentation I technically have presented before, but this part is new for this presentation. What I thought I would do is just provide a little bit of an overview of the most common deductions because I do get a lot of questions about the basic nuts and bolts of these deductions. And so I pulled this off the property tax benefits form, which is available on our website. This is the form that closing agents give to buyers at the closing, and it lists all the most common deductions and the eligibility requirements and so forth. And this might be a helpful cheat sheet to have at your fingertips at your office. Some of you may already have that you use. I think we most recently updated it earlier this year, so if your copy is several years old, there is a newer one available on the website. But to start with, the homestead deduction, that's probably the most common or one of the most common deductions. And this deduction is the lesser of $45,000 or 60% of the gross assessed value of the property. It applies to the dwelling and those structures such as decks and patios attached to the dwelling and the surrounding acre, even if that acre straddles multiple parcels. The statute speaks in terms of an acre. It doesn't speak in terms of parcels. So if you have maybe 2 or 3 parcels that fall within that acre, then that whole acre, those 3 parcels get the deduction of the 1% cap. Now, one question that had come up recently is, what happens if the parcels are divided by a road? And I thought that was an interesting question. I think if it's a private road, if the road is owned by the taxpayer, if it's just a part of their property, I don't think that's necessarily an issue. If it's a public road or alley, that might be a little bit of a wrinkle because the statute technically uses the term immediately surrounding the dwelling. So if you have a parcel that's separated by a public road, I suppose one could argue that's not immediately surrounding the dwellings. That might be a little bit of a wrinkle. I'm not sure how often you might encounter that, but it is something to keep in mind. Now, this deduction applies to property that is the applicant's principal place of residence, meaning the individual's true fixed permanent home to which the individual has the intention of returning after an absence. So what does that mean? Well, if somebody's away on business, or if they're deployed in the military, or if they're simply on an extended vacation for a year or two. Technically, they can continue to receive the homestead deduction during that absence so long as they have the intention of returning and the property is maintained as their homestead during their absence, meaning basically it isn't rented out. Now, we then move on to the supplemental homestead deduction. If the property receives the standard homestead deduction, it automatically receives the supplemental homestead deduction. And this is applied after the standard homestead deduction is applied to the property. This is applied to the net AV that results. And the amount of the deduction is 35% of the net AV if that net is less than $600,000, or 25% of the net AV if the net is greater than $600,000. The energy deductions. There's the solar energy heating and cooling system deduction, and that deduction equals the out-of-pocket expenditures for the components and labor. And then we have a variety of different energy device deductions: solar power, wind, hydroelectric, geothermal. And those deductions equal the assessed value of the property with the device less the assessed value of the property without the device. Now, it's been pointed out that these deductions have somewhat limited value because once the device is installed, the assessed value of the property goes up, and so the cap is going to go up. And so this deduction may have been intended to kind of make the taxpayer whole, but in the end, that may not necessarily happen, and that is just an idiosyncrasy of how this works. I think these deductions may have been implemented before the tax caps, and so maybe this is something that has to be resolved legislatively, but I am aware of that inconsistency, that idiosyncrasy, but it is just sort of built into the system. Now, the hydroelectric and geothermal devices must be certified by Department of Management. The applicant would submit paperwork to IDEM and then receive certification and supply that with the application to you. And one question I have received is, what if the property sells? Does the subsequent owner have to have the device recertified? I think the answer would be no. The taxpayer would probably apply for the deduction in his name, but I don't think there'd be a need to recertify the device if the device is unchanged. Now, the mortgage deduction, another common deduction. This one is the lesser of $3,000. The balance of the mortgage or contract indebtedness on the assessment date, or 1/2 of the total assessed value of the property. Now, if I were to buy a house today and mortgage it today and apply for this deduction today, for 14 pay 15, my deduction amount would be $0 because on March 1st of this year, there was no mortgage balance, and 0 is obviously the least of these three amounts. So for 15 pay 16, then presumably I would have some amount that I would be able to receive, but for 14 pay 15, the amount would be 0. Now, a person cannot have more than one mortgage deduction in his name, but if a married couple owns two properties, so if you have Bob and Sue and they own two properties and each one is mortgaged and presumably the mortgages are in both of their names, Bob could have a mortgage deduction in his name on one property and Sue could have a mortgage deduction in her name on the other property. It'd be the full $3,000 deduction. There'd be no split or anything like that. And likewise, if Bob owns a business, let's say Bob owns a house that he lives in, he has a mortgage on it, he also owns a business, and the business owns a property that has a mortgage on it. Bob could have a mortgage deduction in his name on his property, and his business could have a mortgage deduction in its name on the property it owns. So that is possible. All right, the over 65 deduction. Now, this is a doozy here. There are a lot of different criteria and components on this one here, so I'm going to try to work through them as best I can. This deduction is the lesser of 1/2 of the gross assessed value of the property, or $12,480. The applicant must have owned or been buying the property for at least 1 year before claiming the deduction. Now, this term claiming is used in the statute, and this is a little bit thorny because throughout the deduction chapter of the Indiana Code, the term claim is used, I think, in different ways. Sometimes I think it's used with regard to applying for a deduction, and then sometimes I think it's used with regard to receiving it on the tax bill. So I think that, as these statutes were drafted over the years, I think the term claim has been used in different ways. So where this statute uses the term claim, what does that mean? I've had the question come up, well, does the person have to own the property for a year before applying? Or if they buy a property today, come in and apply for it, and then it won't show up on the tax bill for a year, does that satisfy this criteria? And that's a good question. I think in the past our agency has directed or has advised that the person should own the property for a year before applying for the deduction. I think that makes the most sense because if you think about it, someone could come in today, or I suppose I should say maybe in February of the year, and apply for it. And yeah, it would be a year before it shows up on the tax bill, but 2 months after they apply for it, they could sell the property and move out, and they wouldn't satisfy this criteria. So I think it would be best if they own it for a year before applying for the deduction. But because there is some ambiguity in the law, I think, let's just say Mrs. Smith, who's 98 years old, comes in February and applies for this deduction. She just bought her house and she just moved in. It'll be a year before it shows up on her tax bill. Could you give her this deduction? I think arguably you could. I think there's enough ambiguity in the law that you could, so long as it will be a year before she gets it on her bill. Again, I think the cleanest thing is if she owns it for a year before actually applying for it. All right, moving on. Applicant, any joint tenants or tenants in common must reside on the property, and this would be other than the other spouse. So let's say Mrs. Smith and her husband are the only two people who own the property. Let's say Mr. Smith is in a nursing home. Mrs. Smith would have to reside on the property. The fact that her husband didn't reside on the property would not be an issue. However, if Mrs. Smith and her sister owned the property as tenants in common, and let's say Mrs. Smith's sister was in a nursing home, that I think would be a problem. So again, I think there's a difference if you're looking at spouses versus joint tenants or tenants in common. And I know that's really splitting hairs, but again, we got to work with the statute as it's written. There's also an income threshold. The combined adjusted gross income of the applicant and applicant's spouse or applicant and any joint tenants or tenants in common for the preceding year did not exceed $25,000. We'll talk a little bit more about the income thresholds a little later in the presentation. Assessed value of the property cannot exceed $182,430. The applicant must be at least 65 by December 31st of the year preceding the year in which the deduction is claimed, and there's that word claimed again. I think I would have to be 65 years old, at least 65 by the end of this year in order to apply for the 14 pay 15 cycle, I think is how it would work. I mean, that's what we've advised in the past, and that makes the most sense. So again, if you're applying for 14 pay 15, you'd have to be at least 65 by the end of 2014. The same person cannot have the over 65 deduction in conjunction with deductions other than the homestead, mortgage, and fertilizer storage deductions. Now notice this is in terms of the same person. The same person can't have a certain combination of deductions with the over 65. However, let's say that Mrs. Smith has the over 65 deduction and her husband has the disabled vet deduction. That would be okay. The same property could have that combination. It's the same person can't have that combination. That's an important distinction. The deduction cannot be denied on the basis that the recipient is away from the property while in a hospital or nursing home. And then finally, if any joint tenants or tenants in common are not at least 65, the deduction is reduced by a fraction. And once again, this would not apply with a spouse. So again, if Mr. Smith is 65, his wife is 63, he could have the over 65 deduction. There'd be no fractional reduction there so long as it was just the two of them that own the property. If Mr. Smith and his son own the property as tenants in common, and his son was not 65, then there would be a fractional reduction. All right, now the over 65 credit. Now this is the one time when there's both there's a deduction and a credit. So you're not incorrect to refer to an over 65 credit. There is such a thing. And this prevents a recipient's homestead tax liability from increasing by more than 2% over the previous year. Now, the applicant must have been eligible for the homestead deduction in the preceding year as well as the current year. If the applicant filed an individual income tax return, the income threshold is $30,000 for the individual or $40,000 if it was a joint filing. The gross assessed value of the homestead cannot exceed $160,000. Now, there are no restrictions on combining the credit with other deductions. I know that makes no sense. As we said, with the over 65 deduction, there are some restrictions on how a person can combine that with other deductions. With the over 65 credit, though, there are no restrictions, so you can have this credit in combination with any other deduction. Now, the statute on the over 65 credit has a strange wording with regard to the age requirement here. And if you interpret it literally, it would make it seem that you'd have to be 65 years old by the end of the year preceding the year in which you're applying for the deduction, which doesn't make any sense. So I think it was probably, hopefully, just a drafting oversight or mistake. But definitely somebody would apply for the deduction and credit at the same time. In fact, the same form is used to apply for both. And they'd have to be at least 65 by the end of the year in which they are applying. So just for the sake of uniformity. All right, the blind and disabled person deduction. This deduction is $12,480. The applicant must use the property as his principal place of residence. The applicant must own or be buying the property under a recorded contract. The applicant must provide proof of blindness or disability. And the applicant's individual income for the preceding year did not exceed $17,000. Now, this deduction does not refer to joint filing or anything like that. It just looks at the applicant's individual income. So if the applicant did file jointly, somehow he'll have to parse out or document his portion of the income. Now, there's also the disabled vet deductions. We're going to talk about those in greater detail a little bit later in the presentation, so we'll come back to those. Now, just some helpful reminders. If a deduction is validly in place on the assessment date, it will stay in place for that tax cycle, even if after the assessment date the property changes hands and the new owner is ineligible for the deduction. So if I have a homestead deduction on my property on March 1st, and then 2 months later I sell the property to my cousin and move to the Caribbean, that deduction would stay on that property for that tax cycle, even though I have sold the property and I'm no longer using it as my homestead. Now, that's different from the way that exemptions are handled, at least for 2014 and 2015. And again, that's why it's important to get the terminology right. An exemption, at least in 14 and 15, would come off for the same tax cycle if the property's ownership or use changes and the property no longer qualifies for an exemption. So I don't want to cause too much confusion, but just, again, to emphasize, deductions and exemptions work a little bit differently here. Deductions will stay in place if they're validly in place on the assessment date. Now, another little wrinkle here, what if somebody moves from their homestead after March 1st to another property that they are going to use as their homestead later that year? Under the homestead deduction statute, there is an exception to the general rule that a person can only have one homestead deduction per tax cycle. And that is, if I'm moving from my homestead after March 1st to another homestead, I can receive a homestead deduction on both of those properties for that tax cycle. So again, let's say I move from my house after March 1st to another house in another county, and I'm going to use that as my homestead. I've moved in August, let's say. I can apply for the homestead on that second property for that same tax cycle, and the deduction would stay on the old house for that same tax cycle. So I would technically be getting two homestead deductions for the same tax cycle. That is permissible under this provision, that's subsection H of the homestead deduction statute. For the next assessment date, then obviously the deduction would fall off the first property. Now, it wouldn't be Indiana law if there wasn't an exception to the exception, and that's this third bullet point here. And in this third bullet point, we are hoping to get this corrected through in the next legislative session, which starts in January. But the exception to the exception is that if the property I'm moving to after March 1st was vacant land or an incomplete dwelling on the assessment date, I can still claim a homestead deduction on that property, but the homestead deduction on the first property, the property I'm moving from, has to be canceled. And that, again, makes no sense. I think it was just an oversight when they were implementing this new provision here about the vacant land. And again, we're hoping to get that fixed next session so that there'll be more uniformity, that there won't be an exception to the exception, just an exception to the rule. So it'll be nice and clear and easy for all of us. Last bullet point there, something that had come up, is sometimes people will close on a property on December 31st and sign their sales disclosure form, but they won't move in until the following February. Should that person be able to get the homestead deduction for that tax cycle? And we've said no, the person probably should use the property as their homestead during the year in which they're applying, even if it's a day. I mean, even if they're closing on the 31st and they move in that day, that would be fine. But if they're not going to move in for another couple of months, they probably should not be getting a homestead deduction for a year in which they didn't actually live in the property and use it as their homestead. All right, that was a lot of information, and I think we've earned a laugh. And so I told you this was coming, so here it is. Here's the first of my stellar lawyer jokes. So a stingy old lawyer who had been diagnosed with a terminal illness was determined to prove wrong the saying, "You can't take it with you." After much thought and consideration, the old ambulance chaser finally figured out how to take at least some of his money with him when he died. He instructed his wife to go to the bank and withdraw enough money to fill 2 pillowcases. He then directed her to take the bags of money to the attic and leave them directly above his bed. His plan, when he passed away, he would reach out and grab the bags on his way to heaven. Several weeks after the funeral, the deceased lawyer's wife, up in the attic cleaning, came upon the 2 forgotten pillowcases stuffed with cash. "Oh, that darn fool," she exclaimed. "I knew he should have had me put the money in the basement." All right, that got a pretty good laugh. All right. All right, so moving on to some taxing questions. These are some frequently asked questions that come up. First bullet point here, we talked about earlier, can one spouse receive an over 65 deduction while the other spouse receives a vet deduction? The answer is yes. Again, the same person couldn't have both of those deductions, but the same property could have both of those deductions on it. The third bullet point there, we already talked about the homestead deduction applies to the dwelling and up to 1 acre that surrounds it. State law does not require the taxpayer to combine the parcels in order to receive the deduction on that acre. I just wanted to add that point. Last bullet point there, remember that for 14 pay 15 and beyond, the property must actually be receiving a homestead deduction to receive the 1% cap, and that's by operation of state law. For previous assessment dates, there was a Board of Tax Review decision that said that property simply had to be eligible for a homestead deduction to get the 1% cap. But now for 14 pay 15, property actually has to receive the deduction to get the 1% cap. All right, now, I'm sure many of you are still experiencing PTSD from the verification process, but I'm going to kind of bring it up here, and hopefully you won't have any terrible nightmares or anything as I talk about it. But as you'll recall, the verification program ended at the end of 2012, and if a person failed to file the pink form, the auditor, in his or her discretion, could terminate the deduction starting with the 12 pay 13 cycle and forward. To go back previous years, the auditor has to have an independent reason for doing so. And if a taxpayer who failed to file the verification form comes into your office today and provides proof of eligibility, the deduction has to be reinstated for those tax cycles. They would provide proof of eligibility for the tax cycles for which the deduction was terminated. And again, the deduction would have to be reinstated, and that is by operation of state law. There is no statutory deadline for the taxpayer to come in and do this. So again, if it was pulled for 12 pay 13 and 13 pay 14, taxpayer could come in today. There's no statutory deadline for them to do that, to come in. Theoretically, they could seek a refund. They would be bound to the 3-year window for seeking refunds. There would be no interest due on the refund. And there's also no statutory obligation to file a Form 133. Now, I think Board of Accounts may have advised or suggested that for record-keeping purposes, at least the county may file or fill one out just for, again, for bookkeeping, but the taxpayer would technically not be obligated to fill one out. All they have to do is provide proof of eligibility. In terms of proof of eligibility, an auditor may limit what evidence he or she requests to a state income tax return, valid driver's license, or valid voter registration card. Now, you're not prohibited from requesting other types of documentation. If these do not suffice or if the taxpayer does not have them available. We used to have an administrative rule that listed a bunch of different types of documents that could be used. It was voided when the General Assembly implemented this provision here. But again, theoretically, could you request, if someone isn't registered to vote, if they don't drive, if they don't have to fill out an income tax return, could they provide maybe a bank statement or a paycheck stub or something like that? That might be possible, and again, you can work with the taxpayer to find something mutually acceptable. And then the third bullet point here, a dispute over a homestead deduction for 1 year doesn't necessarily justify requesting years' worth of documentation. So if there's a dispute over 13 pay 14, I would discourage you from telling the taxpayer, bring in the last 5 years of income tax returns. I think that'd be a little bit onerous or a little bit burdensome if only 13 pay 14 is in dispute. If there are 2 or 3 years in dispute, that's a different story. But again, the shotgun approach may be a little bit onerous. Another point here is sometimes, or at least I understand that in some cases an auditor will say, I'll only accept your homestead application if you attach Social Security card or a driver's license or something to it. And under state law, an auditor cannot impose additional criteria on applying for something that isn't in state law. So if someone submits a homestead application form to you, you can't refuse to accept it because someone hasn't attached their driver's license or a Social Security card to it. You would accept the application, look over it, and if something is missing or there's some issue, at that point certainly you could follow up with the taxpayer and request information or some explanation, but you can't impose additional application criteria that don't exist in law. And just a helpful reminder there, some free legal advice. You can't require submission of an entire Social Security number unless there is an explicit legal authority to do so. Just keep in mind, the statute requires the last 5 digits of the Social Security number. All right, another issue that comes up somewhat frequently is the issue of divorce and married couples seeking 2 homestead deductions. So unless a couple is legally divorced, the couple is considered married and is entitled to only 1 homestead deduction. So even if they're living in different properties, if they're still legally married, they're entitled to the 1 homestead deduction. But again, there is an exception to the rule, and I have it cited here. It's subsection N. And it's a very, very narrow exception. This is where you have one spouse lives in Indiana, the other spouse lives in another state. They each own their respective properties in just their own names, maintain separate principal places of residence. If the spouse in the other state is receiving a homestead deduction, it is possible for the Indiana spouse to claim the homestead deduction here. But they have to provide this information here that's outlined. I'm not going to read it verbatim, but again, it's a very narrow exception where the spouses live in different states and maintain separate principal places of residence. But otherwise, the rule is if you're still legally married, you're entitled just to 1 homestead deduction. And this slide just is a continuation of that excerpt that I provided about that exception to the rule. Here's a scenario that came up in December. I received a letter from a taxpayer stating that they have moved and would like their mail forwarded to a new address. Should I pull that person's homestead deduction for the preceding assessment date based on that letter? And very interesting question. I think the problem here is we don't have enough information. We don't know if the person moved before or after the assessment date. As we said earlier, if a deduction is validly in place on the assessment date, it will stay in place for that tax cycle. So if the person moved after March 1st, then the deduction should probably be left in place. If they moved prior to March 1st, they moved in February, then likely the deduction should be removed then. But we just don't have enough information. We don't know with just what we're given. So I think the auditor would have 2 options in this situation. The auditor could err on the side of safety and say, you know what, in the absence of something more concrete, I'm not going to pull the deduction and potentially deprive the person of a benefit they're entitled to. Or the auditor could try to follow up with the taxpayer and inquire, when did you move in relation to the assessment date? I think those would be the 2 options the auditor would have. If the auditor just pulled the deduction, it's making a pretty big assumption that the taxpayer was not, in fact, entitled to the deduction. Now, it is true that the taxpayer is the one who's obligated to notify you of their ineligibility. That is true. But in this case, we don't know if the taxpayer was in fact ineligible. They may not have been ineligible and thus would have had no reason to notify the auditor. The burden is on the taxpayer to notify you of their ineligibility, but as the auditor, you might have to do some due diligence just to make sure, just to play it safe, that someone's deduction isn't improperly terminated. Now, the last bullet point there is a person can use an out-of-state driver's license to apply for the homestead deduction. That is possible. I've heard that, and again, these are just allegations, that in some counties, applications or sales disclosure forms are rejected if an out-of-state driver's license is used, and that would be inappropriate. An out-of-state driver's license could be used to apply. Now, understandably, you might contact the taxpayer or the applicant and say, what's the story here? How come you're using out-of-state driver's license? But there could be legitimate reasons for that. I mean, if someone is moving from out of state and they're applying through the sales disclosure form, on that day, they're not going to have an Indiana driver's license yet because they've just closed on their property. Alternatively, they might have a commercial driver's license, and for work reasons, they may not have an Indiana driver's license. So again, using an out-of-state driver's license in and of itself is not necessarily a fatal problem. It may be a cause for additional inquiry, but it's not necessarily a deal breaker. All right, income thresholds for the over 65 deduction, the blind disabled deductions. I've provided here an excerpt from the over 65 deduction, and it speaks in terms of the combined adjusted gross income of the individual, and there's another part of the statute here. I've also copied it for you. In order to substantiate the deduction statement, the applicant shall submit for inspection by the county auditor a copy of the applicant's and a copy of the applicant's spouse's income tax returns for the preceding calendar year. If either was not required to file an income tax return, the applicant shall subscribe to that fact in the deduction statement. So this is one of those times when you can demand, when someone submits this deduction application to you, that they attach or supply additional documentation because statute requires it. So basically, if I'm applying today for this deduction, I would have to attach a copy of my income tax return that shows my 2013 income. So I would attach that to the application. Now, if I didn't have income that necessitated an income tax filing, then I would simply, as statute says, I would subscribe to that fact in the statement. Now, what does that mean? I think it would just mean I'd probably handwrite a note on the application saying that, you know, I didn't have to file an income tax return, I didn't have income last year. All right, now, over 65 credit also talks about adjusted gross income. And again, for the individual, $30,000 is the threshold. For a joint filing, $40,000 is the threshold. All right, now, so we've got that. All right, we've got that context there. Looking at the blind disabled deduction. All right, this statute says the individual's taxable gross income for the calendar year preceding the year of application did not exceed $17,000. Notice the difference here. This says taxable gross income as opposed to adjusted gross income. Also notice the blind disabled deduction statute has this caveat. For purposes of this section, taxable gross income does not include income which is not taxed under the federal income tax laws. Now that caveat does not appear in the over 65 deduction. Now again, why there are these discrepancies, I know it's aggravating and it makes no sense, but again, probably different legislators drafting these over different stretch of time. But I think what we can do to reconcile these is say that for both deductions, our suggestion would be to look at the adjusted gross income for both of these deductions and to consider only income that is subject to taxation under federal income tax laws. So I think, again, for over 65 deduction and credit and for the blind disabled deduction, look at adjusted gross income and income that is subject to federal income taxation. So if someone has some Social Security benefits, I know in some cases that is not subject to federal income taxes, that would not count. Only income that is taxed under the federal income tax laws. And I've just provided the lines there from the tax forms that show where the adjusted gross income is listed. All right, and I've gotten the question occasionally, you know, when do I have to notify someone that I'm denying their deduction or terminating their deduction? And I think normally you don't have to notify the taxpayer. There are only two exceptions to that. One is if a person doesn't file their verification form and you decide to terminate the deduction. Before you terminate it, you have to notify the taxpayer. The other occasion is this, and it's where someone submits a homestead deduction application to you and you determine that the property is not the person's principal place of residence. You would have to notify them of their ability to appeal that decision. And again, why that only applies to the homestead deduction and not any other deduction, that's just the way it was drafted. So again, I'm just the messenger here. All right, now, before we move into veteran deductions, how about another laugh? Okay. Now, I think this one's pretty funny. I hope you don't find it too irreverent, but I'm going to give it a shot anyway here. So a man woke up in a hospital bed and called for his doctor. He asked, "Give it to me straight. How long have I got?" The physician replied that he doubted the man would survive the night. The man then said, "Call for my lawyer." When the lawyer arrived, the man asked for his physician to stand on one side of the bed while the lawyer stood on the other. The man then laid back and closed his eyes. When he remained silent for several minutes, the physician asked what he had in mind. The man replied, "Jesus died with a thief on either side. I just thought I'd check out the same way." All right. I hope my next one is funnier. I was expecting a bigger laugh on that one. All right. So the disabled vet deductions, the codes, Department of Veterans Affairs has, from what I understand, has discontinued the codes. I think these were used to classify vets based on disability. But I think over the years, they were sort of conflated with the disabled vet deductions. And so I'd sometimes get questions, you know, I have a vet who's code 3, and so he gets this deduction or that deduction. And so it was a little bit confusing, and so it's important to kind of distinguish between the codes and the deductions. The deductions, you know, don't talk about codes or anything like that. Instead, we have basically two primary disabled vet deductions. The first one is for vets with a partial disability. And this one is $24,960. And this is for vets who have a service-connected disability of at least 10%. And of course, the person has to have evidence of the disability. They would receive that from the Department of Veterans Affairs. The vet would have to own or be buying the property under contract. The second bullet point here, I think this appears in a number of different deduction statutes here, but it's a concept where if I'm selling property to you under a recorded contract, and in the contract, you as the buyer are responsible for the taxes, then I as the seller would not be eligible for the deduction, which makes sense because why should I get a deduction when I'm not paying the taxes? And again, I think that shows up in a number of the deduction statutes, but I copied it here for the disabled vet deduction. The other primary disabled vet deduction is for vets who are totally disabled or vets who are partially disabled and at least 62. And this deduction is a little bit less than the other one. It's $12,480. And why it's less, I don't know. Maybe the idea was that the other vet would have a service-connected disability, whereas this vet doesn't. I have no idea why the amount is different. But again, this is for a vet who didn't necessarily serve during wartime. They had to serve in the military, but again, there's no requirement here that it be a service-connected disability. So the vet would have to be totally disabled or at least 62 with a disability of at least 10%. Once again, they'd have to provide proof of their disability, and they'd have to own or be buying the property under contract. Now, what's significant about this deduction is there is an assessed value threshold for eligibility. So, statute says no one is entitled to this deduction if the assessed value of the individual's tangible property, as shown by the tax duplicate, exceeds $143,160. So, I think you would have to look at all of the vet's property, even if let's say he owns a house and he owns houses in 2 counties. I think you would look at the assessed value of both of those houses and see if they exceed this threshold. Now, I've received the question, what if the vet owns property in Florida and Indiana? Do we consider the value of the Florida property? And I would say the answer would be no, because statute says as shown by the tax duplicate. So obviously an Indiana tax duplicate is not going to show property owned in another state. Now, yes, is that fair that someone who happens to own property in Florida could get this deduction when somebody who owns 2 properties in Indiana can't? I understand that does seem a little bit inconsistent, but again, I'm just working with the statutory language as it is, or it says tax duplicate, so I think you'd only be looking at Indiana property. And again, keep in mind it's tangible property, so you'd also have to consider personal property. Let's say he owns a business and he has some equipment and tools. I think you would count that in addition to his residential property. All right, the next slide or two talks about applying for the disabled vet deduction. I'm not going to go into too much detail there. The application process is pretty uniform for deductions. We'll talk about that a little later in the presentation. We discuss legislative changes, so I'm not going to get into too much detail there. This slide just talks about proof of disability. And this slide talks about surviving spouses. So a surviving spouse can claim a disabled vet deduction if the vet satisfies the eligibility requirements at the time of his or her death and the surviving spouse owns or is buying the property under contract at the time the deduction application is filed. And note that the surviving spouse is entitled to the deduction regardless of whether the property for which the deduction is claimed was owned by the deceased veteran or the surviving spouse before the deceased veteran's death. So let's say Mr. Smith passes away, Mrs. Smith moves to a smaller property, a smaller house or condo. She can still obtain the disabled vet deduction on that property even though Mr. Smith did not own it. He had no ownership interest in it at the time of his death. Obviously, the surviving spouse would have to provide the proof of disability when she applies for the deduction. Now, you're probably sick of this joke, but as I've said, if anyone shows up in your office claiming to be a World War I veteran, don't call me, call the Ghostbusters. I don't think there are any surviving World War I vets or surviving spouses of World War I vets, so I'm not going to spend much time on that one. All right, excise taxes. Oh, I think we also just just let out a collective groan right now. Excise taxes. Oh. So excise taxes are a bit complicated here, but with the disabled vet deductions, there's this idea that if there's an amount left over, if you apply the disabled vet deduction to a property and the entire deduction is not used, there's an amount left over, the vet can take that remaining amount and use it toward excise taxes, the taxes he pays at the BMV for his vehicle. So there are two paths that a person could go down with regard to excise taxes. So one path, you have a vet who qualifies for disabled vet deduction, has it applied to his property, has a balance left over. He would come to you and request a certificate. I think it's the Vet 128 form. You would fill that out and indicate the amount of credit that he would be entitled to, and he would take that to the BMV and get his credit. And that's the way it's been done for many years. There's nothing new or different about that. But there's another path that a person could potentially go down, and this is a path for a disabled vet who does not qualify for a disabled vet deduction. And that may be because he's renting an apartment, he doesn't own property, or he's not buying property under contract. Or it could be that maybe he doesn't have a service-connected disability. Maybe he's 62 with a 10% disability, but his house is worth $1 million, so he doesn't qualify for any disabled vet deduction. So for a vet like that, he would go down the other path, and he would come to you as the auditor and request an affidavit from you. And the affidavit would simply say that this vet does not own property that qualifies for a disabled vet deduction. You wouldn't certify any amounts or credits or anything like that. All you'd be saying is he doesn't own property that qualifies for a disabled vet deduction. You would take that affidavit to the BMV and fill out a BMV form and receive a credit through the BMV. And it's the lesser of $70 or the excise credit due for a maximum of 2 vehicles. So those are the two paths that a vet could potentially go down, just depending on what, if anything, he qualifies for. And that second path, this excise-only path, was implemented last year by statute. Now, we have prescribed an affidavit template. It's on our website. That's the web link. And you're welcome to use that. It's not an official state form. You don't have to use that. We just did it as a courtesy to kind of help out. If you want to develop your own affidavit, in consultation with your county attorney, that's perfectly fine. But we do have a template there that you can use if you'd like to. All right, some frequently asked questions about disabled vet deductions. Can a vet receive more than one vet deduction? The answer would be no. He can receive no more than one of those 2 deductions. So theoretically, the same vet could receive the partially disabled deduction and the totally disabled deduction, but he couldn't receive more than one of each of those. It is possible he could theoretically split the deduction between 2 properties. So if he owns houses in 2 counties, he can't have multiple disabled vet deductions, but he could split them between the 2 properties. So I think what he would have to do is probably apply in both counties and make sure he indicates to the auditor what he's trying to do, and the counties would probably have to communicate to apportion or split the deduction. All right, what if the vet owns properties in 2 counties? With whom does he apply? I think I mentioned this already. He'd probably want to apply with both auditors, explain what he's trying to do. I think the application form has you list the properties that you own. The vet would want to make sure he lists those properties so that he can get the deduction on those properties, get it split between those properties. What about trusts? A trust, let's say property is owned by a trust. It is possible for the person with a beneficial interest in the trust to apply for the disabled vet deduction as well as the homestead. So if a trust owns a property, the person with a beneficial interest could apply for a homestead deduction. And these are the criteria here. I'm not going to get too deep in the weeds on that, but it is possible. And what about a vet who owns just a 5% interest in a property? Maybe his kids own the remaining part. Would he be eligible for the deduction, the disabled vet deduction? The answer is yes. 5% ownership interest is still ownership. He would be able to apply and qualify. Can the disabled vet deduction be combined with other deductions? And yes, it is possible. Again, the exception would be the over 65 deduction, but again, we're talking in terms of the same person trying to get a disabled vet and an over 65. That would be a problem. If Mr. Smith gets the disabled vet, Mrs. Smith could have the over 65 on the same property. That would be okay. Keep in mind the over 65 credit can be combined with all other deductions. And I won't even mention World War I vet deductions here. So, all right, what if two vets own a property? If they're both disabled, they both qualify, then each of them could receive the full deduction in their respective names. That is possible. What if a vet owns only personal property? Can he still receive the deduction, or must he own real property? No, the deduction statutes speak in terms of taxable tangible properties. That would include or contemplate personal property. So if, let's say he rents an apartment, but he owns a business and he has some tools or equipment, he could apply for the deduction and receive it on the personal property. That would be fine. Deductions on mobile homes. There is a provision, 611-1240.5, that says that the assessed value of a mobile home cannot be reduced by more than 50%, with the exception of the supplemental homestead deduction. So basically, the deductions cannot reduce the assessed value of the mobile home by more than half, although the supplemental homestead deduction can reduce that assessed value by more than 50%. So the problem is trying to reconcile that with the homestead deduction statute, which gives you a deduction of the lesser of $45,000 or 60% of the assessed value of the property. So how do you reconcile that? And kind of jumping ahead a little bit here to this particular slide, we developed this here as, again, hopefully a helpful guide or guidepost here on how this might work. But, and again, this scenario assumes that the mobile home owner also owns the land the mobile home sits on. Let's say the mobile home has an assessed value of $15,000. The land has an assessed value of $5,000, same owner. So the homestead assessed value is a total of $20,000. 60% of that is $12,000. So that's the amount of standard homestead deduction this taxpayer is entitled to, but obviously we can't apply all of that to the mobile home. We'd be reducing the assessed value by more than half. So what we've devised here is, we would reduce the assessed value of the mobile home by half. That's $7,500. So we would use $7,500 of the $12,000 deduction on the mobile home, and that leaves us with $4,500 left over of standard deduction, and a net homestead assessed value of $8,000. We're assuming there that we've applied some of that to the land. So we would then calculate a supplemental homestead deduction of 35% on that $8,000, which would give us $2,800. So what would happen here is that the assessed value of the land would presumably be completely wiped out. There would still be a little bit of assessed value on the mobile home remaining that would be subject to tax. But the point here is that the deductions could wipe out the assessed value on the land. The mobile home would likely still have some assessed value subject to taxation, but hopefully that is helpful, more helpful than hurtful to you. Yes? Okay. Yeah, I think then in that case, then that person might only be able to get the $7,500 worth of deduction on that, and then you'd still apply the supplemental homestead to it. But I think that's what would have to happen. Yeah. All right. A question that had come up, our county's vendor software set up so that if all of a vet's deduction cannot be applied to a mobile home, we apply it all toward excise taxes. Is that acceptable? And our response was that no, even if a portion of that disabled vet deduction could be applied to the property, to the mobile home, it should be. So even if $500 worth could be used, it should be applied to the mobile home, and then the remaining balance could be used for excise taxes. So your software vendor might have to make an amendment or an adjustment, or you might have to manually override the software, I guess. All right. Legislative changes. All right, oh my gosh, the Heritage Barn deduction. If I got $1 for every time someone asked me about when the application form was going to be out, I'd be in Aruba right now, and Dave Marusars would probably be presenting on this topic to you. This deduction is not available until the 15-pay-16 cycle. So, and that's by statute. The statute says for assessments after 2014. So, it's too early to apply for it right now. We will be releasing the application form late this year, probably in late December, and then the taxpayer could use it to apply for the deduction next year, so it'd be for 15 pay 16. So this is a new deduction, and again, it applies to heritage barns, meaning those barns other than dwellings, and that's important. If somebody is using it as a dwelling, if they've refurbished it and they're living in it now, then that would disqualify them. So barns other than dwellings that on the assessment date were constructed before 1950, retain sufficient integrity of design, materials, and construction to clearly identify the building as a barn, are not being used for agricultural purposes in the operation of an agricultural enterprise, and are not being used for a business purpose. Now, what does agricultural enterprise mean, or a business purpose? What do those terms mean? And that's a great question. Statute does not define those terms. I think, though, that if you have a retired farmer who's using his heritage barn to store some old tractors or equipment, I don't think that would be a problem. I think, if the farmer is still actively farming, if he has an active business and he's storing equipment, or, he's processing things in the barn, that would be a problem. But if it's just, you can use your imagination, a heritage barn, it's probably this, very old, maybe, somewhat dilapidated structure that has historic value, but it's not part of a business or enterprise or anything. That, I think, would probably qualify. And the deduction amount is equal to 100% of the assessed value of the structure and foundation of the heritage barn. Now, a few other nuts and bolts things here. As you know, customary practice has been that if a deduction is validly in place on the assessment date, it stays in place for that tax cycle. That was actually expressly put into Indiana Code this past session. So now it's absolutely unequivocally clear that that is the practice, that is the way deductions are handled. Also the application process for deductions has been made uniform, so that, and again, customary practice has been that you would fill out and sign the application form by December 31st and file and postmark it by the following January 5th. But that has been made uniform now for all deductions. So all deductions are subject to that same application process. Now, Senate Enrolled Act 367 made an amendment to the homestead deduction statutes that active military personnel can continue to receive the deduction even if they're transferred out of state. Now, I'm not sure why this change was needed, because under existing laws, we said earlier, if someone is absent from the homestead, they can continue to receive the deduction during the absence so long as they have the intention of returning and the property is maintained as their homestead. So I think this change was a bit unnecessary, but for what it's worth, it is an express provision in the statute. But again, keep in mind, if the person is renting the house out on the assessment date, then that would disqualify the property from the homestead deduction for that assessment date. Last bullet point there, Senate Enrolled Act 249 introduced a new obligation for auditors. When you make a determination that property was not eligible for a homestead deduction, you are to notify the county treasurer of that determination and do one or more of the following. Make a notation on the tax duplicate that the property is ineligible for the deduction and indicate the date the notation is made, and or record a notice of an ineligible homestead lien. And the purpose behind this is to put subsequent buyers of the property on notice that there may be this liability out there that they're going to have to absorb. Now, what happens if the auditor makes this determination after the title search has already been done? That's a good question, and I suppose that could be a loophole. There may not be a fail-safe way to, catch every one of these that occur. But again, the idea is here to put subsequent buyers on notice. Now, if you realize for 14 pay 15 that a property has a homestead on it that it shouldn't be getting, I think that making a notation, the tax duplicate, would make more sense, because taxes haven't accrued yet for 14 pay 15. There'd be no value to recording a lien. If we're talking about 13 pay 14, then the lien might be of greater value. Now, Senate Enrolled Act 1, this garnered some media attention. This is what created the personal property exemptions. It also introduced a super abatement. And this is a 20-year abatement schedule that a designating body can approve or can grant. After the 10th year, there has to be a public hearing held to verify the taxpayer's compliance with the statement of benefits. Tax caps. Senate Enrolled Act 367 made a slight adjustment to the term residential property. For purposes of the tax caps, that term now includes a single-family dwelling under construction in a land not exceeding 1 acre on which the dwelling will be located. All right, now, let's say I have bought a house and it's incomplete on the assessment date, and I'm not moving in that year. I'm just buying it as an investment. I think based on this, that would be under the 2% cap. But let's say that on the assessment date it was partially completed, but then later that year it's finished and I move in and I use it as my homestead. I apply for the homestead deduction, then for that assessment date, you would get the deduction and the 1% cap. So I think the question here is the property being used as a homestead, or is it just an incomplete single-family dwelling? And I think that is going to affect whether it's the 1 or 2% cap. Also, the 2% cap does not include real property that consists of a commercial hotel, motel, inn, tourist camp, or tourist cabin. Now, in the past, and I think this still holds true, let's say someone owns a hotel and they actually live in part of it, the owner lives in part of it and uses it as his homestead. I think on that portion of the hotel, he could get the homestead deduction and 1% cap. The rest of it would be under the 3% cap. So I think that still holds true despite this change. All right. I've got one more section to go over and one more lawyer joke. A lawyer's dog, running around town unleashed, heads for a butcher shop and steals a roast. The butcher goes to the lawyer's office and asks, "If a dog running unleashed steals a piece of meat from my store, do I have a right to demand payment for the meat from the dog's owner?" The lawyer answers, "Absolutely." "Then you owe me $8.50. Your dog was loose and stole a roast from me today." The lawyer, without a word, writes the butcher a check for $8.50. The butcher, having a feeling of satisfaction, leaves. 3 days later, the butcher finds a bill from the lawyer, $100 due for a consultation. And just think, I'm giving you this consultation for free. So, now, this summer, our agency had begun the process of making some revisions to the sales disclosure form. We have not yet issued a revised form. This is still a work in progress, so the existing form is still being used. I was hoping we'd have a revised form out this year, but it looks like it probably won't be until next year. But as part of this process, we've reached out to a few different entities to solicit feedback and input on what revisions or improvements might be appropriate. And we did get some feedback, and I thought, even though the form has not been formally or officially revised yet, that I would share some of this because it's still appropriate even with the existing form. So one of the biggest complaints we'd received is inconsistency among counties in the way the forms are processed. So I have here excerpted a statute that I think might be of value here. It says, "County assessing officials, county auditors, and other local officials may not establish procedures or requirements concerning sales disclosure forms that substantially differ from the procedures and requirements of this chapter." So state law does contemplate that there may be some variation from county to county in the way that these forms are processed, but there cannot be substantial departure from state law, and I think that's important. So with that in mind, these were some allegations that we had received, and again, I'm not saying that they're necessarily true. I'm just, the messenger is reporting what I heard, but I'm going to try to respond to these claims. Some counties require the signature of a spouse on the form, even though the spouse is not or never has been on the deed or title. And I think our existing FAQs on sales disclosure forms have said for several years that only the spouse completing the form needs to sign it. But if the form is being used to apply for the homestead deduction, then both spouses' information does need to be included in that form. And again, because married couples are entitled to only one homestead deduction, it's important to have both spouses' information to make sure that the other spouse isn't getting a homestead deduction somewhere else. Another question, what ID is allowed on the sales disclosure form for buyer? The existing form captures the last 5 digits of the social and the driver's license, and so that's fine. Again, the existing form is to continue to be used as it is. I think technically under statute, the person has to provide the last 5 digits of the social, and if they don't have a social, then they would provide last 5 digits of driver's license or state ID, and if they don't have that, last 5 digits of a control number issued by the U.S. federal government. So for right now, because of the existing form, it captures last 5 digits of the social and driver's license. Technically, I think under statute, just last 5 digits of social are technically all that is actually required. Third bullet point, the inconsistency in filing tax deductions. Some counties allow for deductions to be filed, and other counties will not allow any deductions through the sales disclosure form, not even the homestead. I hope that allegation is not true or that there's a misunderstanding there, but under state law, sales disclosure form can be used to apply for certain deductions, and if that part of the form is validly completed and filled out, then under state law, the auditor must allow the deduction. Another claim, most counties also require the pink form to be filed to get the homestead deduction anyway, so sales disclosure form information is redundant. Now, maybe this was stemming from, maybe this was coming from the period of time when the verification program was still in effect. As you know, it ended at the end of 2012. So at this point, I don't see any basis why anybody would still be filling out a pink form. But again, if somebody completes the sales disclosure form deduction application portion and it's validly completed, they don't have to file any additional paperwork or forms or anything like that. And likewise, if they're just using the standalone homestead deduction application, then they don't need to fill out a pink form as well or any other additional documentation. Last bullet point, there's the form for filing deductions or for sales disclosure information. And again, the primary purpose of the form is to track sales information that the assessors use in trending and ratio studies, but under state law, the form can be used to apply for certain deductions. Now, Debbie handed me just a few questions that came in. One of these about TIF, that's a Courtney question. She's getting that one. I've talked about when the form for the Heritage Barn deduction will be available. And then this question here, one of our taxpayers has a nonprofit tax exemption on part of their property. Basically, per the assessor's office, 40% of the property is AV exempt. Taxpayer has filed for a mortgage deduction on the property as well. The taxpayer claimed both nonprofit mortgage since the nonprofit covers only part of the total AV. A good question. I think that the deduction could be applied to just that portion of the property that is not exempt. So I guess that 60%, so long as that full 60% is mortgaged by that person, they own the property, then I think that the mortgage deduction could be applied to that non-exempt portion. So anyhow, that was, well, hopefully you got my contact information. If you have any questions, again, feel free to reach out to us. We'll do our best to help, and I appreciate your time.